The Intelligent Investor, the timeless wisdom of value investing. Benjamin Graham was not just another investor. He was a man who changed the way the world understands investing. His principles laid the foundation for modern value investing, shaping the mindset of some of the greatest investors of all time, including his most famous student, Warren Buffett. Buffett once said, "The Intelligent Investor is by far the best book on investing ever written." But what makes this book so legendary? It's not about get-rich-quick schemes. It doesn't promise you instant wealth or claim that you can predict the stock market's every move. Instead, it teaches patience, discipline, and the art of making rational, calculated decisions. The core idea: smart investing isn't about beating the market. It's about avoiding foolish mistakes. And that's exactly what Benjamin Graham explains in this book. The difference between investing and speculating. Most people who think they're investing are actually just gambling. They buy stocks based on hype, emotion, and speculation, hoping the price will go up. They chase hot trends, listen to market noise, and jump in when everyone else is buying. Graham calls this speculation, not investing. Real investing, he argues, is built on logic, discipline, and long-term thinking. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. In other words, a real investor does their homework. They look at the actual value of a company, not just its stock price. They focus on long-term growth, not short-term gains. If you're chasing trends, you're not investing, you're gambling. The market is irrational. Meet Mr. Market. One of the most famous concepts in the book is Mr. Market. Imagine that every day, a man named Mr. Market comes to you and offers to buy or sell stocks. Some days, he's excited and euphoric, offering ridiculously high prices because he believes the economy is booming. Other days, he's depressed and pessimistic, offering dirt-cheap prices because he's afraid of a market crash. The key lesson? Mr. Market is irrational. His mood swings have nothing to do with the actual value of a company, just like stock prices don't always reflect a company's real worth. A smart investor doesn't react emotionally to Mr. Market. Instead, they buy when prices are low, when Mr. Market is fearful. Hold solid investments despite short-term market noise. Sell only when it makes rational sense, not out of panic or greed. The stock market is a voting machine in the short term, but a weighing machine in the long term. That means in the short term, prices are based on emotions, but in the long run, only true value matters. The margin of safety. The golden rule of investing. Imagine you're building a bridge that needs to support £10,000. Would you design it to hold exactly £10,000? Or would you build it to hold £20,000 just in case? This is the concept of margin of safety. Never buy an asset unless it's priced well below its real value. Why? Because in investing, things go wrong. Companies fail. Economies crash. Unexpected events happen. By buying stocks at a discount to their real worth, you give yourself a cushion against risk. The essence of value investing is to buy stocks like groceries, not like perfume. A smart investor waits for the right price. They don't chase overpriced stocks just because everyone else is buying. The three types of investors. Graham says that every investor falls into one of three categories. 1. The defensive investor. The passive investor. Goal: protect capital and earn steady, reliable returns. Invests in diversified, low-risk portfolios, index funds, blue-chip stocks. Avoids market timing or frequent trading. Focuses on slow, steady growth over decades. Best for people who want to invest safely without deep market analysis. 2. The enterprising investor, the active investor. Goal: find undervalued stocks and outperform the market. Looks for hidden gems, stocks trading below their real value. Does deep research into financial statements, management, and industry trends. Buys during market downturns, sells when the price reaches fair value. Best for investors willing to study and analyze companies carefully. 3. The speculator, the gambler. Goal: make quick money based on stock price movements. Follows trends and hot stocks, tries to time the market. Buys based on emotions rather than research. Best for no one. Speculating is gambling, not investing. Graham's advice: be a defensive or enterprising investor. Never be a speculator. Warren Buffett's takeaways from the book Buffett built his empire using Graham's principles, but he refined them. Here's what Buffett learned from the intelligent investor. 1. Buy wonderful businesses at fair prices. Instead of just looking for cheap stocks, Buffett looks for great companies that will grow for decades. 2. Ignore the stock market's daily noise. He doesn't care about short-term price movements. He buys for the long haul. 3. Only invest in what you understand. If you can't explain how a company makes money, don't invest in it. 4. Be fearful when others are greedy, and greedy when others are fearful. Most people buy stocks when prices are high, out of greed, and sell when they crash, out of fear. Buffett does the opposite. He buys when stocks are cheap and holds them forever. Final lessons from the intelligent investor. Benjamin Graham didn't believe in beating the market. He believed in beating yourself. Your biggest enemy in investing isn't the market, it's your emotions. Fear makes people sell at the worst times. Greed makes people chase overpriced stocks. Impatience makes people abandon long-term strategies. The best investors stay calm, rational, and disciplined. So, what should you do? 1. Decide what type of investor you are, defensive or enterprising. 2. Invest in companies with strong fundamentals. 3. Ignore short-term noise, focus on long-term value. Always buy with a margin of safety. 5. Stay patient. Wealth is built over decades, not days. In the end, the intelligent investor teaches us that investing isn't about luck, predictions, or fast gains. It's about discipline, patience, and intelligent decision-making. The stock market rewards those who think long-term and punishes those who act on emotions. Are you ready to invest intelligently?